A New York residency audit asks one question: did you actually leave? The Department of Taxation and Finance is not reviewing your deductions here. It is testing whether you were a resident, a non-resident, or a part-year resident for that year. That distinction decides everything, because New York taxes a resident on worldwide income. Here is what most people miss. There are two separate tests, and failing either one makes you a resident. The first test is domicile. The non-resident audit guidelines direct auditors to weigh 5 primary factors: your home, your active business involvement, your time, items near and dear, and your family connections. The burden sits with you. The standard is clear and convincing evidence, and the guidelines look for unequivocal acts rather than statements of intent. The second test is statutory residency, and it does not care about your intent at all. If you maintain a permanent place of abode in New York for substantially all of the year, and you spend 184 days or more in the state, you are a resident. Any part of a day counts as a full day. So a taxpayer who genuinely moved to Florida can still be taxed as a New York resident, purely on an apartment and a day count. Now the detail almost every published guide still gets wrong. For years, substantially all of the year meant a period exceeding 11 months. Beginning with tax year 2022, the Audit Division generally applies a period exceeding 10 months instead, in years where a residence is acquired or disposed of. If you are reading an article that still says 11 months, it is describing the old policy. The audit itself opens with a letter and a non-resident audit questionnaire. Then come document requests and a day count reconstructed from travel records, toll records, card transactions, and phone data. The general statute of limitations is 3 years, but it does not apply at all for a year in which you never filed a return. Filing the part-year return for your move year is what starts that clock. If the audit closes without agreement, a notice of deficiency follows, and you generally have 90 days to appeal through conciliation or the Division of Tax Appeals. Contemporaneous records are what carry these cases. Build the file before anyone asks for it.